record. Okay, so welcome, as said, to this month's webinar on business rates, past, present and future, with Chris Corney-Lotes, who is one of the partners in the business rates team at BGL Partners. I actually know BGL because I was a client of theirs it's 10 years I have this business next year now. So yeah, over 9 years ago, I was a client for a few years of theirs. So really trust the guys. Chris and James are working actively with some clients at the moment as well. So you are in safe hands. And just before I do hand over, my top tip around business rates, guys or girls, is that you just have a coffee with them maybe every 6 months or once a year. Just pull them in, have a coffee, tell them what's going on in your space, ask them what's going on in the market and with rates, because the saving potentials are huge. I'm talking hundreds of thousands of pounds that can be saved if you know the timing's right and everything else. So do keep in touch with them. Chris will obviously drop and share his details later on this anyway, but lots to learn on rates and lots of tips and advice coming up. So Chris, over to you, and thank you so much for hosting this month's webinar.
Wonderful, Hannah. Thank you very much, and thank you everyone for joining me today. As was kindly introduced by Hannah, my name is Chris Corney-Lotes, and I'm a chartered surveyor, but I'm also one of the partners within the business rates team at BGL. I thought I'd do a very quick introduction as to who we are. I'm hoping. There we go. So this is me on the left. Apologise for my camera screen, by the way. I'm a little bit far away, but we've had some problems with our text. I've had to do this from the boardroom, but that is a close-up photo of myself. As I said, one of the partners of BGL. We are a firm of chartered surveyors that were established in 2010, so we've been around for some time, all of us from bigger firm backgrounds, and our business rates team specialise in mitigating and managing business rates, and specifically this form of property tax. And when we talk about mitigation and managing, I'll come on to it in more detail as this webinar goes on. But really, when it comes down to it, it's just making sure that your businesses are paying the lowest level of tax possible. And as Hannah alluded to, in some cases, that can result in significant savings for your business. And so whether it be through us or through another chartered surveying practice, we would always recommend that office occupiers do get in touch with their professional advisors, because the savings could be significant. In terms of our business, we do advise on all commercial property classes. So I assume, given the title of this group, that everyone will be mainly in the office sector, but we do some work in terms of the retail and industrial markets as well. But our particular emphasis is generally on central London offices and the healthcare sector. I know that there's, by the way, going to be some chat live throughout this presentation, so please feel free to ask as many questions as possible, and I'll make sure to answer those at the very end of this. Now, this is just a quick overview of what we're going to be looking at. Business rates generally is a really complex property type of taxation. So I thought it'd just be best to give you just a very, very high level overview of what business rates are. Generally, the most important questions that you should be asking internally about this property tax. The most crucial aspect, and most of you will be interested in, is how you can reduce or mitigate those business rates. The fourth point will be the check challenge appeal process, which is the main appeal process that is adopted by the Valuation Office Agency. And finally, what the future is for this property tax, because there are going to be some significant changes that will be really, really important to keep an eye on, because even from an organisational perspective, there's going to be a significant onus put on the ratepayer rather than the Valuation Office Agency. So your businesses will need to be really on top of this property tax. And at the very end, of course, there'll be any Q&As. So I'm conscious I will send these slides separately. I'm not sure if a part of the slides are blocked out by the names on the right-hand side, but generally, the first question is what are business rates? And very, very simply, it's a property tax on all non-domestic properties throughout England and Wales. So as I alluded to, this could be anything from a fish farm out in the regions to a high level or very high value office block in the City of London. The values are set by the Valuation Office Agency, who are due to now be a part of HMRC. and they are collected by the local council in which your property resides in. The reason why generally business rates is such a significant topic is because it is usually, from an occupational standpoint, the second highest cost to a business outside of the rent that is paid to the landlord. And there have been so many disputes about the complexity and the overbearing nature of business rates on businesses' overheads. But the reason why that there haven't been many changes is because generally it raises about £25 billion per year, and it remains the most successfully collected tax. So it's a significant chunk of money for local government to fund their services. And I think the collection rate is over 97%, so significantly higher than something like council tax. Now, rating assessments that are applied to commercial property are subject to 3 yearly revaluations now. There is going to be talks through central government about making those revaluations undertaken on an annual basis to keep the property values in line with changing office markets, as an example. But for the purposes of certainly the current rating list we sit in, which starts on the 1st of April 2023 and will end on the 31st of March 2026, and an upcoming revaluation which will start on the 1st of April 2026, these will be done in 3 yearly chunks. So just to give you a bit of an understanding about how your annual bills are calculated, you would probably receive these bills from the councils that you reside in, but they really come under 2 main components, which is the rateable value. And as I said, that is set by the Valuation Office Agency. Those will generally be at the top of your rate bill. And what that value is meant to represent is the Valuation Office's opinion or their interpretation of what that space might reasonably let for from a set valuation date, which is currently the 1st of April 2021. So we always say that if you have a lease or a rent review that had been undertaken in and around 2021, it would be really important to scrutinise the rent that was payable against your rateable value, because in a very simple matter, if your rent is lower than that rateable value, then there's probably some scope to undertake appeal action to reduce your rateable value, which would have an impact on your taxation from the 1st of April 2023 to the 31st of March 2026. And the way that the annual rates are calculated is by applying a multiplier to that rateable value, which is a pence in the pound figure set by central government annually, but generally it's subject to indexes, CPI-linked increases. And for this current rate year, if you have a property or if your office is valued with a rateable value of under £51,000, a multiplier of 0.499 will be applied to calculate your annual liability. If it is over £51,000, then there will be a multiplier of 0.555. Now, some of you may have seen on your rates demand that there are things like Crossrail supplements and City of London supplements, and they are specific to specific parts of Greater London. And as clearly it outlines, the Crossrail supplement has been applied to fund that service, and the City of London supplements are to also fund the specific services within that sub-market or borough, such as the policing. So in terms of rateable values, I just thought I'd give you a bit of an example of what a valuation would look like. I've chosen a random property in Golden Square, which has been valued on a basis of £850 per square metre. To make things slightly more confusing, the leasing market generally deals with rents on a per square foot basis, but in the rating world, we work on a per square metre basis. And so what this valuation outlines to me is that the Valuation Office have valued the space at £850 per square metre. So for argument's sake, saying that the property on the first floor of Golden Square would have let for about £85 per square foot from the 1st of April 2021. They have also put on there the floor area, which they have on their records as 930 square metres, and applying that 930 square metres to that £850 per square metre would give you a rateable value rounded of £790,000. And as I briefly mentioned, a multiplier would subsequently be applied to that £790,000 value to give you your annual tax rate. So when I talked about the very start of this topic, I asked what the key questions that you really should be asking internally. And it's mainly, is that current assessment or the rateable value applied to your space too high? Is it too low or about right? Now, we sit in what is known as the 2023 rating revaluation period. So it runs from the 1st of April 2023 to the 31st of March 2026. And as I said, that is based on the valuation officer's view of the rental value of that property as at the 1st of April 2021. Now, taking back this example, if, let's say for argument's sake, that at the first floor of 25 to 29 Golden Square was let in 2021 for £720,000 as an annual rent, we would be scrutinising the valuation officer's rateable value, and if we are successful through appeal action, that rateable value may be reduced, and that will have a material impact in reducing your tax bill over that 3-year period. The important thing also to look forward to is the 2026 rating revaluation, which will come into place from the 1st of April 2026, and those new rateable values will be based on rental valuation data of the 1st of April 2024. So similarly, as it's quite a recent date, if your businesses have either agreed a new lease recently or they've taken new space around that April 2024 date, then that evidence may be relevant to reduce your tax bill. But simply from your perspective, all you would need to do is provide that lease to your rates expert, and they'd be able to do the analysis and report to you as to see whether there is an ability to appeal. Now, I know I'm going to be sending this to Hannah afterwards, so I won't go through all of these areas in which you can mitigate your business rates, but these are some examples, and I'll just quickly run through the headline figures. Now, it really can be as simple as from a tax perspective of the valuation uplifts getting their floor areas wrong. So if we had undertaken a measured survey on your behalf, and we found that the valuation office had historic records and your area was 20 square meters lower than the valuation officer's, that would be scope for appeal, and that could be backdated to the 1st of April 2023. And additionally, we put the value applied, and that could be in respect of challenging the rate per square meter based on helpful rental evidence, or if there is some comparisons with other buildings in the locality which have also had reductions in that tax rate, there could be an ability to also get a reduction on your property as well. However, probably the most obvious time in which people tend to come to us about their ability to appeal their business rates is due to material changes. So we note material changes as things like external disturbances. So if you had a big set of building works next door to you, or if you had a major development that was happening over the road, or if there were road closures in the area that were materially impacting your quiet enjoyment of the office space, so if there was noise and vibration disturbance, then you do have the ability to temporarily reduce your tax to reflect that disturbance. This could also be from if your landlord is undertaking some internal refurbishment work, so floors above or below you, or if they're making improvements to the reception which can restrict the access. There are avenues to temporarily reduce your tax basis over the course of those works. Now, the final point that we would also look at is something called reliefs. Many of you may be aware of empty rate relief, which can be applied to space that is vacant, or if you're undertaking refurbishment works, which I'll touch on in slightly more detail. But if you're a charity, it's important to know that you are qualified and you are benefiting from the 80% tax relief, or if you're a retailer, the numerous reliefs that have been in place since COVID first started. But again, it's something just worth speaking to your advisor about, because there are a numerous amount of reliefs, there are a numerous amount of appeal opportunities that are available out there to you. All that it takes is a simple conversation, and usually just the provision of a rates bill and a lease, and your advisor will be able to give you a full overview on the ability to save the business money. So I've just given you a couple of photos there of some classic examples where we have been able to save clients money. The first photo on the left was a client in Little Portland Street, which is just off Regent Street in London. And there are two sets of building works that were ongoing just up the road. And as you can imagine, the noise, dust, and vibration disturbance from those building works rendered the office almost incapable of being used. On that basis, we were able to save our client 20% on their tax bill, and that was based over a 3-year period. So it was a significant saving to them and seriously helpful for their overheads. And on the right-hand side is typically an example of road closures, and this was in Islington Green. And generally speaking, if a disturbance is ongoing for over 6 months, then there is certainly scope for appeal action. Generally, road closures will have a lower end allowance or discount provided on their tax basis because it's deemed to not be as impactful as something like party wall redevelopment works, but it's always worth scrutinising the ability to make savings with the Valuation Office Agency. So very quickly, I will touch on the check challenge appeal process. And this is the appeal process that is put in place by the Valuation Office Agency, which was meant to streamline the process, albeit the timescales are sometimes particularly lengthy. The first stage is the check stage. And this is effectively where we are able to scrutinise the factual details or factual records that the Valuation Office Agency hold. So if we wanted to challenge the floor areas that were in place because they were incorrect, or if the Valuation Office had incorrectly held records about raised flooring being present in the property or the quality of an air conditioning system, this would be the stage in which we would challenge that with the Valuation Office Agency. And whilst they have 12 months to review that case, generally they turn it around in about 3 months. The second stage is the challenge stage. And if we were doing a challenge on the valuation of a property, so the rate per square metre based on helpful rental evidence, this would be where we would collate all of our evidence, put it into a supporting statement and send that to the Valuation Office Agency to be reviewed. Similarly, if we were dealing with a building works disturbance case, this is where we would give all the information about the building works disturbance itself, the timeline of the building works disturbance, and any comparable evidence on similar schemes whereby other properties have benefited from a temporary discount. And again, the Valuation Office Agency then have 18 months to review that challenge, but they generally turn around that second stage in 12 months. If the Valuation Office and their agent or the ratepayer are unable to come to an agreement through this appeal process, then you have the ability to take it to what is known as appeal, but effectively it's a valuation tribunal hearing, which consists of a panel of lay members who would hear both sides of the argument, and they would determine where their view in terms of the argument sits right. So they may side with the Valuation Office and not provide any form of a decrease, or they may side with the agent and provide the requested valuation in their challenge document. The cost associated with going to a valuation tribunal hearing is £300, which is refundable in the event of any successful outcome. So even if you don't receive what you want, but there is any kind of reduction whatsoever, then you will get a full refund of that £300 from the Valuation Office, from the Valuation Tribunal. The one thing that I just do want you to be very, very careful of, and I'm sorry about the phrase calling them cowboys, but it's been the usual phraseology that's been adopted throughout the industry. And when we talk about rating cowboys, are firms that are not chartered surveyors. Unfortunately, there are plenty out there, and they have usually fairly specific names relating to business rates, and they will approach office occupiers, they'll approach any form of tenant, effectively promising the world in terms of reductions, and usually they either take an upfront fee and either do a very poor job or do no work whatsoever, or in the worst case scenario, they might actually increase your rateable value itself. It is important to know that throughout these appeal processes that rateable values can go up as well as down. So it is integral that you do speak to a property advisor who have got significant experience in the industry. And if you would not, I mean, obviously BGL partners, we would love to speak to anyone who would need that kind of advice. But generally speaking, I would always recommend that you go to either the RSCS, or the Royal Institute of Chartered Surveyors, or the RSA, the Rating Surveyors Association. And both of those two bodies will give you a list of chartered surveyors that are qualified and would be able to absolutely assist in the process. We've seen very recently there have been some examples of retail occupiers who have been effectively, unfortunately, done by a rating cowboy and had their rates liability significantly increased. So it's really, really important that you do get a chartered surveyor on board to deal with this. Now, I touched very quickly on reliefs, and I sort of ran through charitable relief and the retail relief, but especially for office occupiers, I just wanted to give you a bit of an indication on the reliefs that are applicable during times of either full vacations or partial vacations, because this is going to be probably more relevant to those that are on this call. In terms of the partial vacation, now, if you're as an office manager, you may be part of dealing with rolling refurbishments of a property. So if part of a floor has been vacated and it's in contractor's hands to be improved or refurbished, then there may be an ability to get up to 3 months of relief on that proportion of space that is unused. In a more extreme version, if your office has decided they want to fully refurbish their space and they've completely vacated the property, then there is the ability to claim 100% rates relief, again, up to 3 months on that office space that has been refurbished upon. It's very common now that office occupiers are refurbing their floors almost every 5 to 10 years. So I'm sure many of you have been through a refurbishment project, and it'd be really, really good to check that you have benefited from those relief schemes, because that's when the savings are significant. We are able to go back about 6 years with these councils generally without having particular difficulty in terms of backdating. So if you took on a lease, let's say 5 years ago, and had undertaken a full fit out of the space or a refurbishment of the space, then there still may be an ability to get backdated relief, which again would be a considerable sum to you. Again, here I've just given you an example of an initial fit out period. It's one of the first questions that we ask our tenants, or sorry, our clients when they take on new accommodation is, did you undertake a fit out at the start of your lease? And if so, did you benefit from the reliefs applicable? Because very simply saying that a 3-month break in that tax would save the business a lot of money. And equally, it's worth saying that if you are a person that assists with landlords in any kind of capacity who have a lot of vacant accommodation, then there are mitigation tools available for us to actually reduce your tax liability on that empty space. Some people may have heard of what's known as the box rotation, which is putting storage items into space for 3 months to remove those items subsequently to gain 3 months of relief, which can be undertaken into perpetuity. Or the second usual option is something called the charitable letting, in which the charity is put in place effectively to minimise or mitigate the rates by up to 80%. Both are legal measures of rates management, and something to consider if you do represent a landlord. So just looking forward of the upcoming dates, these are the crucial things to really look out for, because they will have a material impact in the costs of your business. And these are all going to be happening within the sort of next 6 months or so. The first one is autumn 2025, which is going to be the budget announcement from central government. And this will outline the new multiplier for next year. And it will also discuss the potential reliefs that are going to be in place from the 1st of April 2026. And that might be changes to transitional relief schemes, or it could be in respect of retail relief opportunities that are going to be potentially changed. But from an office perspective, what will be really interesting is that by the 31st of December 2025, there will be the release of the draft rating list. And what the draft rating list is the ability for the valuation office to effectively provide all of the projected values that will be put in place from the 1st of April 2026. And it will give you as a business the opportunity to appeal the draft rating list before it becomes live on the 1st of April 2026. It will give the chance for you, therefore, to potentially reduce your tax rate as soon as the new rating list starts, rather than waiting for the new rating list to become live and then going through the rigmarole of what could be an 18-month process to reduce the value. So it's well worth keeping an eye on the draft rating list, or generally just to see from a budget perspective as to where your costs may move from the 1st of April 2026. Now, from us as an agent's perspective, especially if you are a business that has never looked into their business rates, the 31st of March 2026 is going to be a really important deadline, because that is the last possible chance that you can submit an appeal to the Valuation Office Agency to challenge your current 23 rating list assessment. So if you do not submit an appeal before the 31st of March 2026, you will lose that right to an appeal. And that will potentially lose the ability to get savings for up to 3 years, so from the 1st of April 2023 to the 31st of March 2026. So if there's anything to take away from this talk, I would certainly say that if the business rates has not been reviewed as of yet, that someone be instructed to review the position before that 31st of March 2026 deadline, because that could be a very big missed opportunity to achieve savings for your business. Generally speaking, I can't speak for all surveyors, but the norm is that these surveyors will be working on a performance-related fee arrangement. So if there is nothing in the valuation, if we decide that the rateable value is fair and reasonable, there would usually be no cost to the business whatsoever. It's usually done on a percentage of savings basis. So it's absolutely worthwhile approaching approaching an agent just to check your assessment, because it could be at no cost to either confirm that your rateable value is fair and reasonable, or there will be the ability to appeal, and the fee will most likely be borne out of the saving that is made on your behalf. The final date, as I said, will be the 1st of April 2026, and that's when the new 2026 rateable values and multipliers, as I previously mentioned, will go live. So the key changes for the 2026 rating list, and this is going to be really important, some which will be probably overlooked by most, but some others which will actually need a serious review from all office occupiers. The first change is going to be the multiplier structure for the 2026-27 year. And the reason why this is going to change is because central government have made a clear vision that they need to assist and help the retail market. So in the past, as you can see from the left-hand side of the screen, there was the current rating system, which for all rateable values below 51,000, there was one set multiplier. And for all rateable values over 51,000, there was a different multiplier. Now, the system is going to change, in which that small business multiplier is going to be split for properties that are retail focused, and they are most likely going to have the lowest of all multipliers, and the remaining small multipliers on those properties that aren't retail focused. Similarly, that standard multiplier is going to be split into two for those that are retail focused and those that are not retail focused, in an effort, I'm assuming, although that hasn't been released yet, to protect the retail sector. And for those that are probably wondering, therefore, if the retail market is going to have their rates liability reduced, how is this going to be paid for? This is going to be mostly dealt with by the large multiplier, which is going to now be applied to all properties over 500,000 rateable value. And I assume that those with the broadest shoulders will therefore bear the highest costs. So if you do have a large office and you think your rateable value will be over £500,000, and this is an important factor to take into consideration, because it means that the liability will probably grow the largest as well. I should note that we are not sure in terms of the multipliers about how that is going to look. That will be probably released it should be released at the upcoming budget this year. So we'll be able to give you more details by the end of the year. The second, probably the biggest change that is going to be happening in the 2026 rating list, and on a phased basis, is this new duty to notify. Historically, the Valuation Office Agency have been responsible for upkeeping and maintaining a correct rating list. This is now due to change, and they are going to put the onus on ratepayers to implement any changes or notify the Valuation Office of any changes to the property, whether that is the change of occupier, any changes to the lease arrangements, any physical alterations that are made to the property or improvements. These will need to now be declared to the valuation office agency. As I said, as it's pointed out on the slide, this is going to be on a phased implementation basis. We have not been given specific deadlines by the valuation office yet, and we have not been told what that duty to notify or the form that will probably be associated with it will look like. But we are expecting that that duty to notify provision will be fully mandatory by the close of the 2026 rating list. So it will be really important that if you are aware of things like your floor areas being severely underassessed compared to the valuation officer agency's records, that may have to be declared, which will therefore increase your tax liability, but there will be a statutory provision to do that. So it's really important, again, that you have your tax advisor check all of these facts, and they will probably assist with whatever that duty to notify will look like. The final key change will be the modernising of the business rate system. I think most people have had problems with the fact that there is a lack of transparency. We don't generally know how the valuation officer have come to their rateable values when they've been dealing with revaluations. And so that will give the opportunity for you to be able to view how the valuation office has approached your valuations. And it also gives greater digitization of the system, which is hopefully going to speed up most of these processes that are in place, which are generally seen as fairly archaic at this point. So that is the main takeaways. I mean, for me, there are just a few closing takeaways that I would like you to take internally after this meeting, because I appreciate that to condense sort of all the topics in terms of business rates into sort of 20 minutes or so is quite a lot. But the key fact here is that business rates are a significant cost for occupiers of commercial property, and we really should be reviewing the opportunities to make savings wherever possible for businesses. And the second point is understanding how your assessment is calculated. So I did that through the provision of a example rateable value and a multiplier, and also understanding the appeal/relief processes, which could be useful to help identify errors and to see opportunity for savings. So if you do believe that you have a lease or rent review information around the valuation dates that could prove useful, or if you are aware of ongoing building works disturbances or any refurbishments or fit outs that are going to be undertaken by your office or sort of your business, then I would certainly go and speak to a business rates advisor. It's really crucial that you are exploring all potential mitigation options available to you. As I put it at point 3, I think it's really important that you work closely with a professional advisor. It's really important, especially before the 31st of March 2026, that you are proactive with your appeal action and that you are advised correctly in terms of the ways in which to mitigate your business rates. Because if you do come up and deal with a rating cowboy, as we call them, then the outcome could be significantly worse for the business rather than what we tend to work on, which is the good news story of savings and reductions. So it's really important that you speak to the right people. And then, as I've put at the end, it's just reviewing and revisiting the scope for reducing your liability before the 31st of March. That is the key deadline to work to. And then if you want to look at things like the draft rating list, that is something your advisor can review as well. But given that most of these advisors will work on a performance-related basis, it is absolutely crucial that even just having a conversation, or as Hannah said, just having a coffee with someone just to talk through the past of your business in terms of an occupational standpoint is really, really important. And that is me and my details, which I'll leave on there should anyone have any follow-up questions. But thank you very much for the time. I decided to not go into overdrive in terms of the information, because I think, especially with business rates, there can be a lot to digest. But I hope that this has given a high-level perspective on what business rates are and just the key things that you really should be looking out for come the end of this rating list, and the important changes that will be put in place from the 1st of April 2026, all of which will have a big impact on your rates liability. But thank you very much. just having a look in the.
I'm here, sorry.
I was just having a look. I just realised the chat was there.
Yeah, if you answered those, I was going to check just to make sure. Sorry.
Well, yeah. So let me just read out Alison Jackson. So if we carry out refurbishment works on our floor and are not in occupation for the duration of those works, can we claim entry relief for that period? I have the work to take 3 months. Will we be exempt? Yeah, absolutely, Alison. So if there have been refurbishment works on your floor, you will have the ability to claim up to 3 months of empty rate relief. So it'll be 100% tax relief on that floor. Unfortunately, if the refurbishment works go on slightly longer, then you would only be capped at that 3 month period. But it also really depends on the scale of the refurbishment. If it was just a touch-up job, so if you were going through the process of very simply just removing all the furniture and just updating some meeting rooms or doing some repainting, rejigging, then that would be capped at the 3 month relief period. But if the works were substantial, I mean, if you had undertaken a full strip out of the property to a shell and core condition and significantly made improvements to the space, then you could actually delete the assessment from the rating list, which isn't bound by 3 months of relief. So if it was a significant project that took 6 months, and the works were severe enough, then there may be ability to delete it for a longer period. But if it was just a typical refurbishment, then yes, you would be able to be exempt for that 3 month period. From Liz, we've had constant building works around our office, left side, right side, across the road. Absolutely, Liz. If you've had building works that have been going on throughout the last year or so, and if they are still ongoing at the moment, then there are abilities to try and appeal to the valuation office to get a temporary reduction in your business rates. The key matter, sorry, something that I should have touched on during the main bulk of the discussion, is that the key with the appeal for material change of circumstances, so for building works disturbances, is that the works need to be ongoing whilst the appeal is lodged, because when you submit an appeal to the valuation office agency, that is the day in which the physical circumstances are going to be taken into consideration. So if the works have come to an end by the time you appeal, then the valuation office will reject your ability to claim any form of reduction in your rateable value. But if you're in the middle of a building work scheme with a disturbance ongoing, then I would absolutely recommend that you undertake appeal action, and that can be backdated to the commencement of the scheme or the 1st of April 2023, whichever is the later of the two. And then Tia, I think that's lost. Sorry if I've missed anyone. Tia, if you have a big refurb project coming up, do you have to wait until it's complete, let them know about the change of circumstances, or can you let them know before it starts? So Tia, it's a great question. In terms of the timing, generally we would need to give the information to the either to the, as I said, to the council if you're dealing with a relief application capped at 3 months, or if it's a significant refurbishment project where you will actually be taking things to shell and core with a valuation office agency. There are two different bits of timing. I would be telling the council about the space being empty as soon as your furniture has been removed from the space. So as soon as the space is actually empty and you can collate the evidence of the space being empty, that would be the right time to speak to the council. In terms of the valuation office agency, if we're looking for a deletion, then we would need to submit an appeal. Generally, when the works, we're not time restricted to a deletion appeal, but in terms of the timing that I would like to submit an appeal is when the strip out works are at their most complete. So if the space has been taken back to a shell and core condition, I would generally submit my appeal at that point, because you can provide the evidence to the valuation office of the raised flooring or the lighting, etc., being removed, and the space being clearly incapable of beneficial occupation. So generally speaking, to answer your question, it's when the works are ongoing rather than before it starts. And I think that may be it.
Yeah,
Hannah.
you've answered them all. Can you hear me okay?
I hear you perfectly. Thank
Cool,
you.
because I think I muted my microphone and muted the Zoom as well. But
No worries.
lots of lovely comments in the chat. So it seems like this has gone down really well. If you guys do have questions, I will copy Chris in and just share the slides hopefully later today. As before, it will go on the replays area in the portal as well as our YouTube channel. So do feel free to reach out. But as I say, grab that coffee, bring BGL in to have a chat, to have a look at the space, and see where they can save you money. This is how I saved. One of the ways in which I saved two of my last permanent roles, £1.1 million a year between them on their bottom line spend. A lot of that was through rates and cleaning and telecoms and bad contracts, but a lot of it was through rates. So yeah, do definitely have these guys on your books and stay in touch with them. But hopefully that's been really useful. Thank you so much, Chris. As always, appreciate it and all the updates and advice there. And we will see you all very soon.
Really appreciate your time. Thanks very much, everyone.
Everybody.
Bye.